So your firm recently introduced the Natixis Loomis Sales Total Return Bond ETF. Your ticker on that one is LSTB. You also have the Natixis Loomis Sales Dynamic Core Plus ETF, and that ticker is LSCP, both ETFs listed on the NYSE, so congrats on that. Can you break down the strategies, the differences between these two bond ETFs, and then explain how they complement one another?
Yeah, I'm happy to. The two portfolio management teams that run these two ETFs have extensive experience running similar strategies and other vehicle types. As an example, both teams run a similar mutual fund, and combined, those mutual funds have $26 billion in assets. So they're very established, they're very proven over time in other vehicle types. The two ETFs sit within the intermediate core plus bond category, which is a category that's quite large within the fixed income ETF space. It's also a category that's often utilized as a core fixed income allocation for investors. So it's really a meaningful category. So we wanted to focus on a really meaningful category as we began our quest, if you will, into the ETF space on the fixed income side. Now, the two ETFs themselves, so LSTB, is the more flexible of the two strategies. It's managed by the Loomis Sales Full Discretion team, and it follows a benchmark agnostic approach, really value-driven, focused on bottom-up credit research. And again, that flexibility is intended to provide stronger returns than most, but obviously taking on more risk than some. The objective is absolutely total return. Again, income generation and capital appreciation being the source of that return. Now, LSCP, on the other hand, takes a different approach. So two different ETFs for two different buyer types. This is managed by the Loomis Sales Relative Return team, definitely more benchmark aware with tighter risk controls and an emphasis on consistency, greater consistency versus the high return potential of the other ETF. So they dynamically invest across different sectors and again, looking to be in the right place at different times in the credit cycle. So those are the two key differences. Again, one being more opportunistic, one being more of a core portfolio, both sitting in that intermediate core plus category.